Warren Buffett once said. Other guys read Playboy, I read annual reports. When Warren Buffett said this, he wasn't just joking around. It is actually the key to picking the best stock to buy, identifying the company with a durable competitive advantage. Today, we're unraveling the book Warren Buffett and the Interpretation of Financial Statements by Mary Buffett and David Clark. This book outlines the key metrics that Warren Buffett looks for when analyzing the financial statements of a company. Without further ado, let's take a look at the main things to look for in the three financial statements: the income statement, the balance sheet, and the cash flow statement, using Apple as an example. This is just a brief summary of the book. There are plenty more important infos worth exploring in the full book. Make sure to check it out in the link in the description. While at it, be sure to lightly tap that like button, subscribe, and turn on the notification bell to not miss out on our latest uploads. The income statement. First up, we have the income statement. The income statement is a financial statement that summarizes a company's revenues, expenses, gains, and losses over a specific period, typically a quarter or a year. It provides insights into a company's profitability by detailing its ability to generate income and manage expenses. First thing you should look for is the gross profit. It's what's left when you subtract the cost of making or buying the stuff a company sells from how much it sells them for. When we divide this number by the total revenue, we will get the gross profit margin. If it's more than 40%, that's a thumbs up, indicating that the company is pretty good at setting prices and running things efficiently. Here we can see that Apple has met this condition perfectly, sitting at 41%, 43%, and 44% respectively from 2021 to 2023. This is not just recently. Looking back at data from 10 years ago, Apple still managed to sustain approximately 40% in gross profit every single year. Now, let's talk about the money a company spends to keep the lights on. Here we have the selling, general, and administrative costs, or SG&A, and the cash put into research and development, or short for R&D. By comparing these expenses to the gross profit, we get the SG&A/gross profit and R&D/gross profit ratios. R&D/gross profit ratio. This ratio measures the percentage of a company's gross profit that is invested in research and development. R&D expenses are crucial for innovation and developing new products or services that drive future growth. A higher R&D/gross profit ratio may indicate a company's commitment to innovation, but it also warrants careful evaluation to ensure the company is effectively commercializing its R&D investments. With Apple, this ratio is 14.3%, 15.4%, and 17.7% respectively for the year 2021, 2022, and 2023, and never reached 20% in the past 10 years. R&D-heavy companies like Intel can have a ratio as high as 30%. SG&A/gross profit ratio. This ratio calculates the proportion of a business's gross profit that goes towards covering selling, general, and administrative costs. Marketing, sales, and general administration expenses are included in SG&A expenses. Better cost control and efficiency are suggested by a lower SG&A/gross profit ratio, which shows that a business is making more money for every dollar of revenue. A ratio of less than 30% for SG&A/gross profit is excellent, but respectable businesses can have ratios as high as 80%. Apple also fit this condition, since this ratio remained below 20% in the last 3 years, as well as 10 years. By looking at these ratios, Buffett spots companies set up for the long game, managing costs well and investing in the future. Next, we have the net earnings. It is the grand total after subtracting all the bills from the money a company makes. The net profit margin, found by dividing net earnings by total revenue, gives the percentage of revenue kept as profit. Buffett likes companies keeping this ratio at greater than or equal to 20%, never dipping below 10%. Again, Apple completely satisfied this rule, attaining a net profit margin of 25.3%, 25.3%, and 25.9% respectively in the last 3 years. Even looking in the last 10 years, Apple's profit margin stayed comfortably in the green zone. Earnings per share is how much profit a company makes for each share of stock. An upward trend in net earnings and per share earnings over 10 years is a good sign of a company's steady growth. This is again especially true for Apple, since its EPS more than quadrupled its value in 2013 at $1.42 million to $6.13 million in 2023. Here in Apple's income statement, there are two types of EPS, basic and diluted. Although it is beyond the scope of this video, basic EPS is like looking at the current situation, while diluted EPS is like considering what could happen in the future if certain things change. We usually look at the diluted EPS since it gives a more scientific result. The balance sheet. Moving on to the next financial statement, we have the balance sheet. A balance sheet is a financial statement that provides a snapshot of a company's financial position at a specific point in time. It presents a summary of a company's assets, what it owns, liabilities, what it owes, and equity, the value of its ownership. Current assets are assets that are expected to be converted into cash within 1 year. They are the most liquid assets on a company's balance sheet, meaning they can be easily sold or converted into cash. Some of the most important ones include cash and cash equivalents, and inventory. Cash and cash equivalents. This includes cash on hand, deposits in banks, and short-term investments that can be readily converted into cash. Buffett believes that companies should have enough cash on hand to meet their short-term obligations, such as accounts payable and wages, without having to resort to borrowing or selling assets. He also believes that companies should have a cushion of cash to cover unexpected expenses, such as a sudden downturn in business or a legal settlement. Inventory. This represents the stock of goods or materials that a company holds for sale. Buffett believes that companies should have efficient inventory management practices in place to ensure that they are not tying up too much capital in excess inventory. Excess inventory can be a drag on a company's profitability, as it ties up cash that could be used for other purposes, such as investing in growth opportunities. Therefore, if inventory is rising, the net earnings must also be rising. Taking a look at Apple's net earnings and inventory, we can definitely see a positive correlation between the two. Long-term assets. Long-term assets are assets that are expected to be used for more than 1 year. They are not as liquid as current assets, meaning they cannot be easily sold or converted into cash. One important long-term asset is PPE or property, plant, and equipment. This includes machinery, equipment, buildings, and land that the company uses to produce and sell its goods or services. Buffett believes that companies should invest in well-maintained and productive PPE, which does not need constant upgrades, as this will help them to maintain their long-term competitive advantage. PPE that is in good condition will be more efficient and productive, and it will also last longer, which will save the company money in the long run. Current liabilities. Current liabilities are like the company's bills that need settling within a year. Short-term debts, including accounts payable and short-term loans, fall into this category. Buffett recommends keeping short-term debt levels conservative to avoid financial vulnerability during economic downturns. Excessive short-term debt can strain a company's finances during tough times. Another player here is long-term debt coming due within a year. Buffett advises companies to manage their long-term debt maturity schedule wisely, ensuring they can refinance or repay without stress. Long-term liabilities. These are debts that stretch beyond a year. Buffett's advice is to keep long-term debt at conservative levels to retain the ability to invest in growth opportunities. High levels of debt can hinder a company's ability to borrow for new initiatives. He suggests companies generate enough net earnings to pay off long-term debt within 3 to 4 years. By comparing Apple's total non-current liabilities to its net income, we can see that Apple can pay off its long-term debt in less than 3 years, which is exceptional. Shareholders' equity. This represents the ownership interest of shareholders in a company, calculated by subtracting total liabilities from total assets. Retained earnings. The cumulative profits a company has earned and kept reflect the ability to generate profits and hold on to capital, a positive sign for long-term profitability. Here on Apple's latest balance sheet, the retained earnings is named accumulated deficit, which is basically negative retained earnings. This means that Apple's expenses were exceeding its income. This is not always a bad thing, however. It could be that Apple is paying more dividends to its shareholders, or it is buying back shares to increase its EPS. We will look more into this in the cash flow statement. Buffett suggests keeping an eye on return on shareholders' equity, ROE, by dividing net income by total equity. Consistently high ROE points to efficient use of shareholder capital and is a measure of a company's profitability relative to its investment in shareholders' equity. Here we can see that, in the past 10 years, Apple's lowest ROE was 31.83%, and recently gotten as high as 197% in 2022. Comparing this to other competitor, Samsung's ROE was only 6.18% as of September 2023. The cash flow statement. Finally, we arrive at the cash flow statement. A cash flow statement is a financial statement that summarizes a company's cash inflows and outflows over a specific period, typically a quarter or a year. It provides insights into a company's ability to generate and manage cash, which is crucial for its survival and growth. Capital expenditures, CAPEX, signifies cash outflows for acquiring or enhancing long-term assets. In Apple's cash flow statement, CAPEX is termed payments for acquisition of property, plant, and equipment. Buffett values companies with measured, consistent CAPEX, reflecting prudent reinvestment of earnings for sustained competitiveness. The CAPEX/net income ratio gauges the efficiency of this reinvestment, a crucial metric for Buffett. Generally, CAPEX/net earnings under 25% for 10 years is perfect, and it should never exceed 50%. In this statement, this ratio is 11.3%, 10.7%, and 11.7% respectively in the past 3 years, and it remained below 30% in the past 10 years. Dividends represent a company's distribution of profits to shareholders at regular intervals. Buffett values firms with a consistent dividend history and a propensity to increase payouts over time. This reflects a commitment to shareholders and underscores the company's ability to generate sustainable earnings. Apple's dividends over the last 10 years have been consistently increasing, which is a good sign for investors. Stock buybacks. Buffett likes it when companies buy back their own shares, especially if they do it when the shares are priced lower than their real value. By looking at how much they buy and when, along with how it relates to dividend payments, you can figure out if the company's leaders are confident about its future and how they manage their money. If a company buys a lot of shares when the market is down, it shows they're focused on growing for the long term. Also, if they shift from paying dividends to buying back shares, Buffett sees that as a positive move. Apple has been consistently purchasing their shares. Doing this is beneficial as it can increase the earnings per share we discussed earlier. Let's say we have 1,000 shares and a net earnings of $1,000, then the EPS is $1. If the company buys back 100 shares, meaning that there will be 900 shares left, now the earnings per share is $1.11. Augmented payout ratio. The augmented payout ratio integrates both dividends and buybacks in evaluating a company's capital allocation. Calculated as dividends plus share repurchases / net income. A sustainable ratio indicates a company's prowess in generating excess cash. When looking at Apple, they have managed to achieve over 100% in some years, indicating that the company is distributing more money than it earns. Alright, now that we have gone through all three of the financial statements, let's recap what we have discussed. For the income statement, gross profit margin should be over 40%, shows the company is making a good profit. Operating expenses, SG&A, R&D/gross profit ratio. High ratio means they're investing in new stuff, but check if it's paying off. SG&A/gross profit ratio. Below 30% is excellent, up to 80% is cool. It's about how well they manage costs. Net earnings should be 20% or more, never less than 10%. More profit is always good. Per share earnings, EPS going up for 10 years is a green flag. It means the company is growing steadily. For the balance sheet, current assets. Cash and cash equivalents, enough cash for short-term bills. Inventory, keep an eye. Rising inventory should match rising profits. Long-term assets. PPE, property, plant, and equipment stuff they own should be in good shape, not falling apart. Current liabilities, keep short-term debts chill, don't go overboard. Long-term liabilities, pay off long-term debts in 3 to 4 years, don't let it linger. Shareholders' equity/book value, ROE, return on equity. High ROE means they're using money wisely. Retained earnings, positive sign indicates long-term profitability. For the cash flow statement, capital expenditures, CAPEX, keep CAPEX under 25% for 10 years, never go over 50%. Dividends, give back to shareholders consistently, increasing is a good sign. Stock buybacks, if they're buying their own shares when they're a good deal, that's a plus. Augmented payout ratio, check if they're good at making money and sharing it with investors. Technical analysis of companies' financial statements offers one approach to managing your finances, but what role does human psychology play in shaping our financial choices?